Basics of Investing. Chapter 7, Fundamental Analysis. Section 1, Financial Statements. Financial statements matter because they turn a business from a story into something you can actually test. As an investor, you usually want a few basic questions answered before anything else. Is the company profitable? What does it own and owe? And is it actually bringing in cash? The income statement helps with profits. The balance sheet helps with financial position, and the cash flow statement helps with cash generation. If you read only one of them, you can miss important problems hiding elsewhere. A company can report healthy earnings while cash is weak, or show lots of assets while carrying too much debt. That is why serious analysis starts by using all three statements together, not treating any single number as the whole truth. Each of the three core statements answers a different question about the same business. The income statement covers a period of time, like a quarter or a year, and shows whether the company turns sales into profit. The balance sheet is different because it is a snapshot taken on one date, showing assets, liabilities, and shareholders' equity at that moment. The cash flow statement tracks actual cash moving in and out of the business over a period. When you combine them, you get a much fuller sense of both financial health and sustainability. A profitable company with a weak balance sheet or poor cash flow is not as strong as it first appears. Reading the statements together helps you connect performance, financial stability, and real cash generation into one story. The income statement shows how sales flow through the business and eventually become profit. It starts with revenue, which is the money earned from selling goods or services. From there, the company subtracts the cost of goods sold, leaving gross profit, which tells you how much is left after direct production or product costs. Then operating expenses, interest, and taxes are deducted to arrive at net income. This statement covers a period, so it is useful for seeing whether the business is becoming more or less profitable over time. One strong quarter can be helpful, but trends across several periods usually matter much more. As you read it, pay attention not just to the final profit number, but to where margins are strengthening or weakening along the way. The balance sheet shows the company's financial position at a single point in time. Its basic equation is assets equal liabilities plus shareholders' equity, and that equation helps organize the whole statement. Assets are what the business owns, such as cash, inventory, equipment, and sometimes intangible items. Liabilities are what it owes, including loans, accounts payable, and other obligations. Shareholders' equity is the residual value left after liabilities are subtracted from assets. For investors, this statement is especially useful for judging liquidity and leverage. It helps you ask whether the company has enough short-term resources, and whether it relies too heavily on debt to support the business. The cash flow statement focuses on actual cash, which is one reason investors pay close attention to it. Profit and cash are not always the same, because accounting rules can recognize revenue or expenses before the cash moves. Cash flow from operations shows whether the core business is producing cash. Investing cash flow shows money used for long-term assets or received from selling them. Financing cash flow captures borrowing, debt repayment, dividends, and stock issuance. A good habit is to compare operating cash flow with net income to see whether reported profits are being supported by real cash generation. If earnings look strong but operating cash flow stays weak, that gap deserves a closer look. A practical reading order makes statement analysis much easier. Start with the income statement to understand revenue, margins, and net income because that gives you the basic picture of profitability. Then move to the balance sheet to see what supports that profit story in terms of assets, liabilities, and equity. After that, check the cash flow statement, especially cash from operations, to see whether the business is turning accounting profit into cash. The final step is to connect the statements and ask whether profit, debt, liquidity, and cash flow all make sense together. This is where the most useful insights often appear. Looking across several years instead of one isolated period also helps you separate durable patterns from short-term noise. The differences between statements can reveal issues that a single report might hide. For example, profits may be rising on the income statement while operating cash flow is weakening, which can suggest slower customer payments, inventory buildup, or aggressive revenue recognition. A business can also report strong earnings while carrying a heavy debt load on the balance sheet. In that case, profitability may look attractive, but financial risk could still be increasing. Weak liquidity is another warning sign. because a company can seem healthy overall yet struggle to meet near-term obligations. Not every gap is a problem, since some accounting items affect profit without affecting cash right away. Still, when the statements tell noticeably different stories, that is usually a signal to investigate rather than move on. Greenleaf Outfitters shows why it helps to read all three statements together. Revenue of $100 million and net income of $25 million suggest the business is clearly profitable. On the balance sheet, assets of $200 million, liabilities of $80 million, and equity of $120 million. Liabilities of $80 million and equity of $120 million indicate a solid base and a reasonable amount left for shareholders. Its current assets exceed current liabilities, which points to decent short-term liquidity. Operating cash flow of $30 million is even stronger than net income, and that is often a positive sign because cash is backing up reported profit. At the same time, the note that debt helped fund expansion reminds us that growth may have been supported partly by borrowing. So the overall picture is attractive, but debt use is still something an investor would want to monitor over time. Financial statements are powerful tools, but they are not a complete map of business value. Most of what they show is backward-looking, because they record what has already happened rather than what will happen next. They also depend on accounting rules and management estimates, which means reasonable people can still arrive at slightly different reported results. Another limit is that profit is not the same as cash, so a company can look successful on paper while facing real cash pressure. Important assets may also be missing or understated, especially things like brand strength, loyal customers, internal software, or management quality. Those factors can be critical to future returns even if they are not captured well on the statements. So financial statements inform judgment, but they do not replace judgment. Many beginners make the mistake of treating net income as the one number that matters most. In reality, good analysis also checks debt, liquidity, and cash flow, because profit alone can give a misleading sense of safety. It is also risky to assume that book values on the balance sheet equal true economic value. Accounting values are useful, but they are not always the same as what assets are worth in the real world. Footnotes and accounting policies matter more than people expect, since they explain how revenue was recognized, how assets were valued, and whether unusual items affected results. Comparisons can also go wrong when companies are placed side by side without context. The best habit is to ask better questions. Are profits supported by cash? Is debt becoming a concern? And do the numbers make sense for this kind of business? Section 2. Ratios. Once you understand the statements, ratios help turn raw numbers into something easier to compare. A company with $10 billion in revenue is not automatically better than one with $1 billion. So ratios help level the playing field. They let you compare businesses of different sizes and track changes over time within the same company. Ratios also help organize analysis into practical questions about profitability, liquidity, debt, and efficiency. Instead of just staring at dollar amounts, you can ask whether the company is producing strong margins, carrying too much leverage, or using assets productively. That makes ratio analysis a tool for clearer thinking, not just for calculation. The ratio itself is never the final answer, but it often points you toward the right next question. Most financial ratios fall into 4 main groups, and each group answers a different kind of question. Profitability ratios ask how well the company generates earnings from sales, assets, or shareholder capital. Liquidity ratios focus on short-term financial flexibility and whether near-term obligations can be paid comfortably. Leverage ratios look at reliance on borrowed money and the risks that come with it. Efficiency ratios examine how productively the business uses assets such as inventory or total capital invested in operations. Thinking in groups helps prevent random analysis. Instead of calculating ratios just because they are available, you start with the issue you actually want to investigate. Profitability ratios measure how effectively a company turns business activity into earnings. Gross margin shows how much of each sales dollar remains after direct costs, so it can reveal pricing power or production efficiency. Net profit margin goes further by showing what remains after all expenses, interest, and taxes. Return on equity, or ROE, measures how much profit the company generates relative to shareholders' equity. Higher values are often attractive because they suggest stronger economics, but context matters a great deal. A low-margin retailer and a high-margin software company can both be healthy businesses if their models are different. Profitability ratios are most useful when you compare them with the company's own history and with similar firms in the same industry. Liquidity ratios are about short-term survival and flexibility. The current ratio compares current assets with current liabilities to show whether the company appears able to cover obligations due within a year. The quick ratio is more conservative because it removes inventory from current assets, recognizing that inventory may not turn into cash quickly. If either ratio falls below 1, that can be a warning sign that short-term stress is possible. But extremely high liquidity is not always positive either, because it may suggest cash or other resources are sitting idle instead of being used productively. The right level depends on the business model, the stability of demand, and how predictable the company's cash flows are. In practice, these ratios are often most useful for spotting deterioration before it becomes obvious elsewhere. Leverage and efficiency ratios help you judge both risk and operating quality. Debt to equity compares total liabilities with shareholders' equity and gives a quick sense of how much debt the business is using relative to owner capital. Higher debt can improve returns in good times, but it also makes the company more vulnerable when conditions weaken. Efficiency ratios shift the focus from funding to execution. Inventory turnover shows how quickly inventory is being sold, while asset turnover shows how much revenue the company generates from its asset base. Higher turnover often suggests assets are being used effectively, although the right benchmark depends on the industry. A grocery chain and a utility company will naturally have very different efficiency patterns, so comparison only works when the businesses are genuinely similar. A ratio by itself rarely tells you much. Its meaning comes from comparison, and the best comparisons usually come from three directions: the company's own past, its direct competitors, and the broader industry average. Looking at history helps you see whether a ratio is improving, stable, or drifting in the wrong direction. Comparing with competitors shows whether management is performing better or worse than peers facing similar conditions. Industry averages are useful because they remind you that normal levels differ across sectors. A valuation or leverage ratio that seems high in one industry may be completely ordinary in another. This is also why multi-year patterns matter more than a single year. One data point can be noisy, but a trend is much more informative. Good ratio analysis follows a simple process rather than a random list of formulas. Start by deciding what question you want answered, because that tells you which ratio actually matters. Then use data from the same reporting period so the comparison is consistent and not accidentally distorted. Calculate carefully using the correct inputs and definitions, since small mistakes can change the conclusion. It also helps to watch for unusual one-time items that can make reported earnings or assets look stronger or weaker than normal. In some cases, adjusting for those items gives a clearer picture of the ongoing business. The goal is not just to produce a number, but to produce a number that is meaningful. The contrast between Walmart and Apple shows why business model context matters so much. Walmart's net margin is much lower because discount retail depends on huge sales volume and thin per item profit. Apple's net margin is far higher because premium pricing and a different cost structure support stronger profitability. Their debt-to-equity figures also look different, but that does not automatically mean one is safer and one is riskier in a simple way. Apple, for example, may carry more leverage on paper while also holding large cash reserves that reduce practical debt risk. The key lesson is that the same ratio can reflect very different realities depending on how a business earns money. Ratios are useful, but they become much more powerful when you interpret them alongside strategy, industry structure, and financial flexibility. Precision Parts gives us a chance to turn formulas into judgment. Its current ratio of 1:39 suggests the company can likely cover near-term obligations, but the margin of safety is not especially large. The quick ratio of 1:00 is tighter, which means liquid assets excluding inventory just match current liabilities. Debt to equity of 1:00 is tighter equity of 1, 40 points to meaningful leverage, though not necessarily extreme leverage by itself. The more important detail is trend and benchmark comparison. The current ratio is below the 1:8 benchmark and down from 2.0 historically. That tells us liquidity is still adequate, but it is weakening. So the overall conclusion is not that the company is in immediate trouble, but that short-term flexibility deserves closer monitoring. Ratio analysis becomes less useful when investors treat it like a shortcut instead of a tool. Relying on just one ratio can create a false sense of clarity because businesses are too complex to be summarized by a single measure. Comparisons across unrelated industries are also a common mistake, since normal margins, leverage, and valuation levels vary widely. Another problem is ignoring accounting differences, outdated data, or unusual events that distort the numbers. Even the direction of a ratio is not always obvious. High can be good, but sometimes it signals excess risk, and low can be bad, but sometimes it reflects a conservative balance sheet. This is why ratios should support judgment rather than replace it. The best analysts use several ratios together and always connect them back to the actual business. Section 3. Earnings. Earnings matter because they show whether a company is profitable and whether that profitability is improving or fading. Investors watch earnings closely because they are one of the clearest recurring signals about business performance. Earnings also feed directly into valuation measures like price to earnings, which means they affect how expensive or cheap a stock appears. That is one reason earnings reports can move stock prices so quickly. The market is not just asking whether the company made money, but whether the result fits the broader story of growth, margins, and future potential. A rising earnings trend can support confidence, while a weakening trend can change expectations fast. So earnings sit right at the intersection of business performance and market pricing. Reported earnings are the official starting point for analysis because they follow GAAP accounting rules. Those rules create a standardized framework, which makes it easier to compare one company with another and to compare one period with the next. Reported earnings include revenue and recognized expenses, along with interest, taxes, gains, and charges. That completeness is useful because it captures the full official result, not just a selective version of it. At the same time, reported earnings can include unusual items that may not reflect the core business very well. So GAAP results are not the final word, but they are the baseline you should begin with. A good analyst starts with the official number before making any adjustments. Operating earnings are meant to show how the core business is doing. Instead of focusing on every item that affected net income, they center on profit from normal day-to-day operations. That usually means looking at earnings before interest and taxes, or at least excluding clearly non-operating gains and losses. For example, a retailer's operating earnings should mostly reflect selling products, managing inventory, and controlling expenses, not a gain from selling a building. This makes operating earnings especially helpful when you want to judge business quality and execution. They answer a simpler question than net income does. Is the company's main engine running well? That makes them a valuable bridge between reported results and deeper earnings analysis. Adjusted earnings try to provide a cleaner view of ongoing profitability by removing items management considers unusual or non-recurring. These figures are often called non-GAAP earnings, and they can be helpful when one-time charges or gains distort the official result. For example, a restructuring charge, a write-down, or a legal settlement may not reflect the company's normal earning power. But there is an important caution here. Adjusted earnings are not standardized in the same way GAAP results are. Management has some discretion over what gets excluded, and that can make comparisons harder. Investors should always ask whether the supposedly unusual item is truly rare, or whether it keeps showing up. Adjusted earnings can be useful, but they deserve scrutiny rather than automatic trust. 1/4 of earnings can be noisy, which is why trends matter more than a single report. A business may face temporary supply issues, timing shifts, weather effects, or one-off costs that make one period look unusually strong or weak. When you zoom out across several quarters or years, the underlying direction becomes easier to see. Rising earnings over time can signal stronger execution, good demand, or improving margins. Declining earnings may point to competitive pressure, weaker sales, or rising costs. Longer views also reduce the risk of overreacting to short-term volatility. Investors are usually better served by asking where earnings are heading than by obsessing over one isolated number. Markets pay close attention to earnings surprises because stocks are often priced around expectations, not just around results. Analysts publish earnings per share estimates, and the average of those estimates becomes the consensus forecast. If reported EPS comes in above that level, the market often treats it as a positive surprise. If it comes in below, it is usually seen as a negative surprise. That is why a company can report higher earnings than last year and still see the stock fall if investors expected even more. The reverse can also happen when weak-looking results are better than feared. Earnings surprises matter, but they should still be interpreted alongside guidance, business quality, and the reasons behind the result. A solid earnings review moves from the headline number to the business underneath it. Start with the income statement and understand the official result first. Then identify any unusual gains or charges that may have pushed reported earnings away from the company's normal operating picture. If management provides an adjusted earnings figure, review what was excluded and decide whether those adjustments seem reasonable. After that, compare actual EPS with analyst expectations to understand the market reaction. Finally, step back and ask what the report means for valuation and future outlook. Good earnings analysis is not just about whether the company beat or missed by a few cents, but about whether the long-term thesis is getting stronger or weaker. ZebraTech is a good example of how different earnings views can lead to different interpretations. The company reported GAAP of $1.50, which was below the $1.70 consensus estimate and would likely be seen as disappointing at first glance. After adding back a restructuring charge and subtracting an insurance gain, adjusted EPS comes to $1.55. That is a little better than the GAAP figure, but it still misses expectations. However, core operating earnings grew 8% year over year, which suggests the underlying business may be improving even though the headline result was weak. This creates a more nuanced picture. The investor's job is to decide whether the miss reflects a temporary reset or a deeper problem in the business. A common mistake in earnings analysis is to stop at the headline EPS number. One-time items can significantly distort earnings, so ignoring them can lead to the wrong conclusion. It is also important not to confuse operating earnings with net earnings, because they answer different questions. Adjusted figures require caution too, since two companies may both report adjusted earnings while excluding very different kinds of items. Overreacting to a single quarter is another trap, especially when the longer-term trend still looks healthy, and management's adjustments should never be accepted without scrutiny. Strong earnings analysis means reading the details, checking the bridge from GAAP to adjusted numbers, and asking whether the profit is durable. The main takeaway from this section is that there is no single perfect earnings number. GAAP earnings give you the official bottom line, operating earnings help isolate the core business, and adjusted earnings attempt to remove unusual items. Each view adds something, but each also has limits. Good analysis compares all three rather than choosing one and ignoring the others. It also checks earnings against market expectations because valuation and price moves depend heavily on surprise and sentiment. Most of all, it focuses on trend and quality over time. Durable, repeatable profits matter far more than a flattering number in one quarter. Section 4. Sector Analysis. Sector analysis adds an important layer of context before you judge any single company. It groups businesses by broad area of the economy, such as technology, healthcare, or energy, so you can study the environment they operate in. Companies in the same sector often face similar customers, cost pressures, competitive dynamics, and regulations. That means some opportunities and risks are shared, rather than company-specific. If you ignore the sector backdrop, it is easy to misread a company's performance. A firm may look strong partly because the whole sector is benefiting from favorable conditions, or weak because the entire industry is under pressure. Sector analysis does not replace company research, but it helps you ask better questions before you begin. Different sectors behave differently because they respond to economic conditions in different ways. In stronger expansions, technology and consumer discretionary companies often benefit from rising spending and greater appetite for growth. In weaker periods, sectors like utilities and healthcare can hold up better because demand is steadier and less dependent on economic optimism. These differences come from shared demand patterns, cost structures, and sensitivity to the broader economy. Some sectors are cyclical, meaning they rise and fall more with growth conditions. Others are more defensive, meaning they tend to be more resilient when the economy softens. Understanding that difference helps investors avoid treating the market as if every industry moves for the same reasons. It also improves comparisons, because you start evaluating companies against the right backdrop. A sector view helps investors ask sharper questions about growth, risk, and profitability. One useful starting point is to ask whether the sector itself is expanding or slowing, because that can shape expectations for individual companies. You also want to know what is driving revenue growth across the group. In some sectors, it may be pricing. In others, volume, user growth, commodity prices, or regulation. Sector analysis also highlights which costs and risks matter most, such as labor, raw materials, interest rates, or policy changes. That matters because profits are influenced not just by company execution, but by the forces affecting the whole industry. In this way, sector analysis turns vague impressions into a more structured investigation. Sector analysis fits naturally into a top-down investing approach. In that process, you start with the broad economic outlook and ask which parts of the market may benefit or struggle under those conditions. From there, you narrow your focus to sectors that look attractive or vulnerable. Only after that do you compare individual companies within those sectors. This approach can save time because broad themes help direct your attention toward the most relevant opportunities first. For example, if falling interest rates appear likely, you might spend more time studying growth-oriented sectors. The key idea is that the economy shapes sectors, and sectors shape the environment individual businesses face. A structured process makes sector analysis more consistent and much more useful. It helps to begin with a standard classification system, such as GICS, so you are comparing genuinely similar businesses rather than mixing unlike companies together. Then identify the main drivers of growth and profitability in each sector. For technology, that might include user growth, pricing, and research spending, while in energy, it might be production levels and commodity prices. After that, gather sector-level data such as revenue growth, margins, and valuation metrics. Once those pieces are in place, you can compare sectors on growth potential, risk, and relative strength. The value of the process is not complexity, but consistency. Sector performance is often tightly connected to the macro backdrop. Rising inflation may support some commodity-linked sectors, especially if prices for raw materials are moving higher. Falling interest rates can benefit growth-oriented sectors by making future profits more valuable and credit conditions easier. Recession risk often pushes investors toward defensive sectors such as utilities, healthcare, or consumer staples. Strong demand can lift cyclically sensitive areas like industrials or consumer-focused businesses. But these relationships are tendencies, not guaranteed rules. The broader environment shapes which sectors look attractive, yet company-specific fundamentals still determine which businesses within those sectors are worth owning. Choosing an attractive sector is only the beginning, not the end of the analysis. A strong sector can still contain weak companies with poor balance sheets, weak margins, or bad execution. At the same time, a generally weak sector can still include exceptional businesses with durable advantages and disciplined management. That is why sector analysis should guide your attention rather than make the decision for you. Once a sector looks interesting, you still need to study each company's finances, competitive position, leadership, and profitability. In other words, sector analysis helps you decide where to look. Company analysis helps you decide what to buy. Technology and energy offer a clear example of why sector comparisons must include valuation, growth, and macro sensitivity together. Technology often trades at a higher forward price-to-earnings multiple because investors expect faster revenue growth. Energy often trades at a lower multiple, but growth may be slower and profits can depend heavily on commodity prices. Technology can also be more sensitive to higher interest rates, since a larger share of its value may come from profits expected further in the future. Energy, by contrast, may benefit more when inflation stays elevated and commodity markets are strong. Neither sector is automatically better. The better choice depends on which macro conditions you expect and whether the valuations already reflect those conditions. Sector analysis has limits, and those limits matter. Sector boundaries are not always clean, because many companies operate across several business lines at once. Popular sectors can also become overvalued, which means a strong story does not always lead to a good investment. Valuation norms differ across industries, so a high multiple in one sector may be reasonable while the same multiple in another may be excessive. Another common mistake is assuming that a strong sector makes every company in it strong. Sector tailwinds help, but they do not erase weak execution, poor capital allocation, or balance sheet problems. So, sector analysis works best when it provides context rather than a shortcut. Used well, sector analysis helps frame opportunities and risks before you zoom in on individual companies. It is most valuable when you compare sectors against both their own history and their peer groups, rather than relying on one static metric. That broader view helps you see whether a sector is expensive, resilient, cyclical, improving, or weakening. It also keeps you from leaning too heavily on a single number, like price to earnings. No one metric can capture growth, margins, risk, and macro sensitivity all at once. The best use of sector analysis is to sharpen judgment and improve company research. It gives you clearer context, but the final investment case still has to be built at the company level. Section 5. Macroeconomics. Macroeconomics matters because companies do not operate in isolation. The broader environment shapes demand, input costs, financing conditions, and investor sentiment, all of which can change the outlook for the same business over time. A company can look excellent during a period of strong growth and low interest rates, then face a very different environment when inflation rises and borrowing becomes more expensive. Those macro shifts can affect profits directly and valuations indirectly. They also influence how much risk investors are willing to take and what kinds of businesses the market prefers. This is why company financials alone are not enough. Macro analysis adds the context that helps explain why conditions change. Macro analysis starts with a few big questions rather than a flood of data. Investors want to know whether growth is accelerating or slowing, because that affects demand for goods and services. They also watch inflation to see whether price pressures are stable or rising. Spending by consumers and businesses matters because it gives a read on real economic activity, not just theory. Interest rates are another major factor, since they can either support borrowing and expansion or restrain them. Together, these questions help investors judge whether the environment is becoming more supportive or more restrictive for business activity and risk-taking. That judgment is often more useful than trying to predict every data release. GDP is one of the broadest measures of economic activity because it tracks the total value of goods and services produced in an economy. When GDP is growing steadily, businesses often benefit from stronger demand, which can support revenue growth. That is why investors pay attention to output and demand trends when thinking about company prospects. But stronger growth is not always purely positive. If demand rises too quickly, the economy can overheat, which may create inflation pressure. In response, central banks may raise interest rates to cool things down. So GDP growth can support business performance, but very fast growth can also set up the conditions for tighter policy later. Inflation affects investing through both company profits and market valuations. When prices rise too quickly, households lose purchasing power, which can weaken demand for some businesses. At the same time, companies often face higher labor, materials, and other input costs, which can squeeze margins if they cannot raise prices enough to keep up. High inflation can also push central banks to raise interest rates. Those higher rates matter for valuation because they reduce the present value of future cash flows. That tends to put more pressure on long-duration growth stocks, where much of the expected value lies further in the future. So inflation is not just a consumer issue or a cost issue. It can reshape both earnings potential and how the market prices those earnings. Employment data gives investors a window into the strength of the economy and the health of consumers. Reports like payrolls and unemployment help show whether people are finding work and earning income. More jobs usually support spending, which is positive for many businesses. But there is a second side to the labor market. If unemployment becomes very low, wages may rise faster as companies compete for workers. That can be good for households, but it can also increase business costs and add inflation pressure. So employment data can signal both economic strength and the risk of overheating. Investors watch it not just for growth, but for what it may imply about wages, inflation, and future policy. Central bank policy affects markets far beyond the official rate decision itself. When rates rise, borrowing becomes more expensive for households and businesses, which can slow spending, investment, and credit growth. When rates fall, financing conditions ease, which can support demand and business activity. But markets also react strongly to policy guidance, meaning what central banks say about the future path of rates. Expectations often matter as much as the actual move. Bond yields, stocks, and currencies can all shift based on a change in tone. The effects are not uniform across sectors either, because some industries are more sensitive to borrowing costs and discount rates than others. That is why investors pay attention to both the action and the message. Macro conditions do not hit every sector in the same way. Technology is often sensitive to interest rates because its valuations may depend more heavily on profits expected in the future. Utilities and consumer staples are often more defensive because demand for essential services and goods tends to hold up better when growth slows. Banks can sometimes benefit in rising rate periods, but only if loan demand remains healthy and credit quality does not deteriorate too much. So even when the same macro backdrop applies to the whole market, the impact can vary widely across industries. The key drivers are growth exposure, financing needs, and the stability of demand. This is why macro analysis and sector analysis fit so naturally together. The business cycle is a useful framework for organizing macro conditions, even though it is not a precise timing tool. In expansion, growth, jobs, and earnings usually improve. At the peak, growth may still be positive, but inflation pressure can build and conditions may start to tighten. In contraction, output weakens and unemployment often rises. At the trough, conditions bottom out before recovery begins. The challenge is that these phases are often difficult to identify in real time. Boundaries are fuzzy, and the clearest labels usually come only in hindsight. So the business cycle is best used as a guide for thinking, not as a perfect signal for market timing. Macro data is most helpful when used as context rather than as a prediction machine. Many indicators are backward-looking, which means they describe conditions that have already happened. Some reports are also revised later, so the first number investors see may not be the final one. Markets additionally react to surprises relative to expectations, not just to whether the level of an indicator seems high or low. A mildly bad report can lift markets if investors feared something worse, while a decent report can disappoint if expectations were too high. This is why one data release should rarely drive a major conclusion by itself. Trends across multiple reports are usually much more informative than a single headline. A practical macro process starts broad and becomes more specific. Begin by tracking a few major indicators such as GDP, inflation, jobs, and retail sales, because together they give a rough picture of growth and demand. Then review interest rate decisions and central bank guidance to understand how policy may be changing. From there, estimate where the economy may be in the business cycle, while remembering that this is always an imperfect judgment. Once you have that backdrop, move down to sectors and ask which ones may be helped or hurt. Finally, test individual companies for resilience by looking at demand stability, debt levels, cash flow, and balance sheet strength. Macro should shape your questions, but company analysis still determines the answer. The inflation surge and aggressive rate hikes in 2022 offered a clear example of macro forces affecting companies very differently. Growth-oriented technology firms faced heavier valuation pressure because higher rates reduced the present value of profits expected further in the future. Cash-burning businesses also faced rising financing costs, which made it harder to fund expansion. Consumer staples, by contrast, generally held up better because demand for basic goods is steadier even when the economy becomes more uncertain. That did not make every staple company attractive or every tech company unattractive, but it did shift the backdrop in meaningful ways. The lesson is that macro conditions can reshape sector performance quickly. Even so, you still need company-level analysis to confirm which firms are actually strong enough to navigate the environment. A few mistakes can make macro analysis less useful than it should be. One is treating GDP or any other broad indicator as if it were a forecast rather than a rough snapshot of conditions. Another is overreacting to one release. Even though data is noisy, often revised, and best read as part of a trend, it is also a mistake to assume all sectors will respond the same way to the same environment. Different industries have different sensitivities to growth, inflation, rates, and financing conditions. Finally, investors should not ignore inflation-adjusted figures because nominal growth can look strong even when real purchasing power is weak. Good macro analysis stays cautious, trend-focused, and tied back to company fundamentals.